As the lights of festivities sparkle across the country, we are celebrating a quarter century of Samvats here at CNBC TV18 as we turn 25. Here's wishing everyone a very happy Diwali.
Indeed, a happy Diwali to all of our viewers, and what a prosperous Samvat it's been. A 30% rise for the Nifty alone, with SIP inflows at record highs. But just as we take a break from our hectic routines this festive season and the festivities give us a moment to pause and reflect, it seems like the markets too are shifting into a slightly lower gear. Maybe some reflection there as well.
Looks like it. I mean, the question is this just a speed bump, a slowdown, or maybe even a chance to step in? After a long euphoric run, questions are emerging. Before we bring in our star-studded Samvat Baitak to answer and debate all of these questions, let me quickly set things up, putting some points on the table. First up, while starting valuations have been pretty high for markets, we've been seeing earnings downgrades come through across the board. The MSCI India index is currently trading at about 24 times one-year forward earnings. That's at a level we've seen only twice in the recent history, back in 2007 and once again in 2021. Both times the markets were riding high, but we all remember how corrections followed. Relative to other markets as well in the region, in Asia Pacific, the MSCI India is also running at a significant premium. The current price to earnings ratio premium is at 70%. Relatively speaking, a steep jump from the 5-year average, which is about 55%. This is some investors wondering if the market's recent exuberance has gone a little too far, too fast. We've also had a weak Q1 and an ongoing weak Q2 as well. And analysts are asking if H2 recovery will materialize. A lot depends on this festive season. Let's get to flows now. Domestic mutual funds have been stepping in to prop up the markets. They've bought nearly $10 billion month to date, effectively countering the $10 billion in FII selling we've seen. Now, starting cash balances at mutual funds were between $16 to $18 billion. Add to that the monthly inflows that we're getting, which is about $4 billion into equity mutual fund schemes. But with a massive IPO pipeline, QIP pipeline, which is expected, which is lined up, the question many are asking is, if the FI selling continues, will mutual funds start to run out of dry powder soon? And of course, we can't ignore the bigger global picture, the outcome of the upcoming US elections, combined with the impact of ongoing global conflicts. It's still unknown, but these are uncertainties which are looming. There are also some questions being raised by investing veterans in the US about how certain should we be that markets and the Fed's big interest rate cutting cycle will indeed materialize.
So, well, there you heard it. Lots and lots of talking points, plenty of questions, and enough to debate and discuss. So, let me now welcome Mr. Raamdeo Agrawal as well as Mr. Navneet Munot on the stage. They need no introduction. Market veterans have seen many, many cycles and many, many Diwalis. Please, if you could join us on the stage.
Welcome to this stage, welcome to the program. We've done many Samvats together, and as I said, this is a special one for us because 25 Samvats. So it's been a long journey as CNBC celebrates 25 years as well. Great to have both of you here. So, I mean, I think we put on the table a lot of questions really about what we're seeing. Is this finally the correction that everybody was saying is not coming? Are we finally seeing it? Navneet, you go first.
No, first of all, many congratulations to you on 25 wonderful years. I think India has come a long way, and you guys have contributed to that journey of India, to the journey of capital markets and the wealth creation, phenomenal wealth creation that has happened in last 25 years in our career. Always say that there is this book of Malcolm Gladwell, Outliers, where people born in a certain part of the year, they do well in life because there is some big change happening. I always say that people like us who got so lucky, who joined the market in early 90s, have done so well. If you had integrity and was working hard, you've done so well. But the next 25 years look even better. Notwithstanding this correction, and we can discuss more about it, I don't think that the last few days give you any reason to worry about the next 25 years. This was expected. This is a healthy correction. I think there was a point where the momentum had taken over, where people were not discriminating between a good news or a bad news. The stocks had to go up every day. But this cannot continue. Trees don't grow to sky. Trees don't grow to sky. And I think some bit of correction is very, very healthy. And I think there is a bit of sanity check. And I think from here on, maybe a little bit more time correction plus some price correction, things will start looking good again.
Raamdeo ji, what's your thought?
Congratulations on 25th year of CNBC, and I have seen it all. In a sense, I think I've been coming for 25 years here, and you guys kept patience with all the fools like us, and actually made us grow. I mean, the contribution of CNBC for the capital market growth, even Motilal Oswal's growth or our brand equity growth has been immense. So thank you very much for that. Coming back to your question about correction, it is the healthiest possible correction and overdue correction, I would say. And even if a bit more, in fact, it will be deeper the correction, better it is for the people, because the expectations were going wild. You know, some people are saying that I want only 2-3% monthly return, month on month, that too compounded. So, you know, that expectation was running wild, and once the expectations are way beyond, see, ultimately, even last 5-year return is just about 16% of the Nifty.
Correct.
Your 1-year return could be whatever, how so exciting it is, but 5-year is just about 6.5%, 10-year is just about 14%, 25 years 15%, 40 years 15%. So that's the base rate of India. So anchoring the expectation, and you just see today it's a different market. Out of 175-80 million people, only 30-35 are the people with more than 5 years experience. Otherwise, all of them are seeing market for the first time.
Exactly.
So I don't know how they behave, and for them to set wrong expectation and get disappointed in a very early stage, I think that would not be very good.
They say it's always better to lose money when you start. So then you're a little bit more cautious. I mean, and not be in euphoric times, because then you expect euphoria all through the investing.
So you can come simultaneously. I mean, like 1 lakh crore, 2 lakh crore can flow in simultaneously. But if they get disappointed for a prolonged period, then they can also exit simultaneously. And that can destroy the market.
Let's ask the person who's part of the industry that's emerged sort of supreme, right? In the last, I think, 5-7 years, what Indian mutual funds have done, how they've evolved and how they've led the market is the amazing story. So Navneet, that's the $10 billion question right now, right? And will that inflow keep coming in and offsetting all the FPI selling? You know, what does anecdotal data, ground checks and your gut tell you?
So we're lucky to be called market movers, but the real market movers are the retail investors of India. The resilience that they have shown, the maturity that they have shown is really credible. And of course, you guys have played a role in handholding them through the ups and downs. But I think we have come a long way as an industry. 25 years back, when you guys started, maybe the total industry size would have been 1 lakh crore. Today, we're talking about 67, 68 lakh crores. What a journey that the industry has seen. We have added more AUM in last 1.5 years than what the total AUM we had 10 years back. That's the pace at which the money is coming. And the best part is a large part of that money is coming in the form of SIPs. And the 24,500 crores is ticket size is 23 or 400 rupees per month per ticket. And that makes us very positive about the structural aspect of financialization of savings in India. I'll just give you 2 data points. 24,500 crores into 12 is almost $35 billion. I don't remember in last 25 years when you started, was there any year where foreigners invested more than that? No. Just see the power of this money. Number 2 is, as an industry, we are almost $800 billion. And Raamdeo ji has been meeting, we have been meeting global investors all our career. I think this was the size of US asset management industry in late 80s, sometime in 87, 88. In the next 10 years, from 88 to 98, they grew from almost $800 billion to $5 trillion. So you know where we are headed. I call this the India's 401k movement. The difference is, without a tax incentive, without a large fiscal incentive, I think it's a voluntary on a voluntary basis, individual investors saving every month on a disciplined basis for their retirement nest. This is one of the biggest revolution that has happened, and I feel very positive about India on the sustainability of this.
You know, it's uncanny, Navneet, that you're making that statement sitting exactly at the same place. I think it was about 6 months back, same place and same forum. We had Chris Wood sitting on that chair where you're sitting today, and he made this exact same reference point saying the way the US market went, that 401k moment over the next 2-3 decades, and India is, you know, starting on that cup. So that's amazing. I mean, both the views, of course, sort of coming together there. But Raamdeo,
there will be many countries in next 20, 30, 40 years who will say we are exactly where India was in 2000.
Where the US, where India was. Okay.
Let me just finish that point. Very near, again, forgive me, but very near term, if I have to ask you. I mean, that point that I made, $4 billion is coming into equity mutual funds.
Little more than that.
Little more than that. I mean,
last 3 months, the gross inflows have been almost 1 lakh crore per month.
Right.
The net retention, if you include the equity funds and hybrid funds put together, plus the equity index fund, would be almost 50,000 crores a month.
Okay. So my question is this. So there is that money which is coming in. There's a starting cash balance, which is, as I said, about between 16 and 18 billion dollars. But FIRs are selling. They sold about 10, 11 billion dollars already. What about dry powder with mutual funds? I mean, local money has supported even as FIs are exiting. We don't know what they will do, and we will talk about that, what is triggering this and whether we are done with the bulk of outflows. Just the dry powder, if this continues, will be at some point...
There used to be a time when we see this kind of volatility or a market fall, we had to travel and tell people that please keep patience, don't worry, markets would come back. Today it's other way around. When I look at the purchase transactions, on the days when you see a correction of 1.5%, 2% or so, very few sessions in last few weeks, I see a substantial increase in the purchase transactions.
And I think Raamdeo ji also...
This is the maturity which is very, very different. People want to top up their SIPs on those days. There will be some cyclical aspect. There will be like maybe if markets don't do well for few months, there will be few people may take some money off the table or may probably wait for some time to put additional money to work. But the structural trend is very much intact.
Raamdeo, just to complete that point, would we run into trouble if this continues, if selling continues? We hope it does not.
No. If the pace continues the way they are doing it, like close to $500 million per day, because bulk of, see, in the last 20 days, we have exhausted quite a bit of the reserve.
Mutual fund cash reserve.
My sense is maybe 60-70% is already deployed, because correspondingly as much is being bought despite that's why market fall is very, very regulated, I would say. So as your reserve comes down, now if their adjustment is not complete, see, other thing is that adjustment is also not unlimited. They are selling primarily for adjustment. The guys who are underweight China and overweight India, they are trying to balance the thing and they are going back to China, whatever is the neutral weight, and coming back to India also in neutral weight. So that's earlier estimate was about 15 billion max. So we have done about 11, 12, maybe another 2-3 to go at best. So I don't think there is much of selling left. But then it's anybody's
on
call.
Account of China.
On account of China. Then comes our own. So there is a daily flow. That flow I don't think is still impacted. And there must be some guys who are deeper into cash. They would still be there. So I don't think there is any crisis kind of situation right now. But if by chance that China-related outflow turns out to be 25-30 billion, and that in one shot,
then that
could be a deeper correction.
But that's not what you're expecting right now. You're saying maybe another $2-3 billion, perhaps more.
There is no rationale to expect. These are unknown things. You know.
That's true.
Like earlier, people were saying from where correction can come. Okay,
and
here you are.
Exactly. Nobody perhaps imagined that it will be because of suddenly FBI is starting to sell, right? But on moving to another issue, and typically when you're dealing with one, it's like Murphy's Law and more things pile up. And now suddenly we're dealing with a slowdown in earnings. This is the first time we're talking about single-digit sort of earnings growth. And now there's a big issue about consumer, whether there's a bigger consumer slowdown in the making. Raamdeo ji, where do you stand on the way earnings are and whether this is just a temporary blip or whether this is something that's concerning you?
It has to be a temporary blip because we cannot go from 4 trillion to 8-10 trillion without consuming more soaps, more milk, more everything. I mean, consumption has to take place. 60-65% of the economy is about consumption. We'll need more car, more motorcycle, more bicycle, everything will need more. Just that this is an adjustment phase, post-COVID, all the rich guys, they are buying. So it's a K-shaped recovery. And I hope that it trickles down and private capex picks up. There are a lot of hopes. But right now, consumption is not looking to be very exciting.
Navneet, comment on this. Again, this was one of the things that market will always give you what you don't expect, right? Which is why the market's the best teacher. So the FPI selling was one aspect, and now suddenly there's talk of urban consumption slowdown. Your thoughts on what you're seeing and hearing from companies?
No, so there's surely a moderation in growth in the urban India from the base that we had earlier. You look at footwear, apparels, QSR, passenger vehicles, across the board. You can really feel it, and I'm sure companies are telling you that, companies are telling us that. There seems to be some bit of uptick, or at least early signs of uptick in the rural growth. Over the last couple of years, everybody has been talking about a K-shaped recovery. The premium products doing well, but the rural consumption is not doing well. I think we are seeing some bit of reversal. Maybe the terms of trade are shifting with higher food prices, which is like hurting, let's say, an urban consumer, but probably benefiting a rural consumer who's more dependent on agri income, better monsoon, and maybe welfare spending. We can discuss the separate aspect of that in the long run, what it can do to macro stability, but maybe the higher welfare spending by the state governments, last 14 or 15 governments in last 6 months have announced some or the other scheme, that money probably is helping the rural consumption. So that's a brighter aspect, but yeah, I mean, we are all concerned about the slowdown in consumption. 2/3 of our economy is consumption, and if you have these numbers of single-digit growth, that's definitely concerning.
That's consumption, that's one part of it. But Raamdeo ji, on earnings overall, I mean, I remember in our earlier conversations earlier this year, you've been talking about reasonable expectation to have like 12 to 15% earnings compounding. Are we still on track with that trajectory?
No, that is the main pain point. Like at the beginning of the year, my head of research told me, Raamdeo ji, we have done 1,000 this year and 1150 next year. For sure, it can only go up, it cannot go down. First quarter result, he comes down to 1100. Now this quarter result is not even out, he's already at 1070. I said, where will you go up? Are you going to back to 1000? Yeah. So, the pace of decline in the earnings is quite alarming, and their estimate for this quarter is just about 6-7%. Even if you see the business standard aggregates, it's just about 6-7%. And so we are not seeing too many bright spots in the earnings side, and markets are at all-time high. So, these are two. See, market is also dull, dead, 12, 13, 14, 15p. That matches,
Yeah.
But right now, market expectations are running at more like 15 to 20% kind of earnings growth, and here is a market which is kind of, and supply is building up, massive supply is building up, and other side the earnings are disappointing. So this is concerning.
But does the consumer need help? There is only two ways: monetary or fiscal. Do we need to start to think about that?
He's the guy to tell.
But RBI has mentioned, I think the governor has mentioned that we don't have the scope for rate cut in the near future. They want to build the credibility of anchoring the inflation expectations around 4%, which in the long arc of thing is a good thing. Think about the way risk premiums can come down. Sure. If you are able to build that credibility that your policymakers will ensure inflation in India stays around 4%. This is what US did in 80s and have benefited for 4 long decades of ensuring a non-inflationary continued expansion, a nice era, I think, which India will also have. From the fiscal perspective, as I said, that state governments are spending more on the welfare side, but I think we need to have a right balance. They also need to do the capex. So the last 3 or 4 years or 5 years, the central government has done the heavy lifting, expecting that private sector will come in and state governments will also step up on their spending on the capex side. That hasn't really happened to the extent that was expected, and I think that will be one of the main trigger for the growth recovery, because once you have that investment cycle kick in, then you create the jobs, then people have more incomes which they consume as well as save, and then it gets converted into investments. So you get into a virtuous cycle. Just throwing more money into people's pocket to get growth for 1 or 2 quarters won't structurally help us.
One more aspect on the local issues, and then we'll get to global. What's happening with BFSI, and for the longest time that's been the sector that people are waiting to sort of see take off. But what we're realizing is that because the RBI is as prudent as it is, we're seeing issues right now, whether it's slamming the brakes on unsecured lending or whether it's gold financing, and that's showing up in the earnings of those entities as well. So, sir, where do you stand on what we're seeing, these asset quality concern, rise in slippages, RBI action? What are your thoughts when you're looking at financials now?
Financials, at least on lending side, is pretty tough. I mean, regulator is coming heavily on them to control the rate of growth of, then they're saying your credit deposit should be less than 100 or 70, 80, whatever. So clearly there is a regulator doesn't want to go wrong in terms of excessive expansion of credit or maybe unhealthy credit. They are seeing early signs of slippages. So lending side definitely looks to be kind of stuck in the sense that there is no 20-25% growth kind of scenario. And that was the sector which was leading the pack. And that is the largest part of the index also. And that's why private sector banks, if you see, they were the growth warriors, like they'll grow at 25%, 22%, that kind of thing. So that has been, because liability mobilization, another controversy which slightly is dying down is about money is coming to the stock market, and hence banks are not getting enough money. So I think maybe Navneet has a better answer.
Market comes off a little bit that problem.
People are not buying soaps because
शाम को ultimately जाके पैसे तो HDFC बैंक में जमा होना.
Absolutely. Yeah.
So I think it is about more about the money supply.
Cannot impact the bank deposit growth.
I think that issue has been explained and has been debated, and I think it's now been put to rest.
I hope, exactly, has been put to rest.
But then what that also tells us is that if you're expecting growth and sort of the driving engine to be consumer, that's not the case. If you're expecting financials to do that heavy lifting, that's not going to be the case. So then what do we look out to? I mean,
not that bad, by the way. I mean, it's let's say the expectations were very high relative to what we are delivering now. I would put it more that it's a cyclical slowdown than something very structural. All the structural story that we've been talking for last several years, the reforms that have happened, the investment we are making in infrastructure, be it physical, digital, and social infrastructure, everything else that we have done, I think that will play out the way it was envisaged. We are going through maybe a period of cyclical slowdown, but I remain optimistic on the longer end.
Now also, it feels like Diwali.
One of the things that what we are discussing today, and you talked about the valuation relative to 2007 and 2021. Right. One of the things you need to keep in mind that this time what we are discussing is an earnings slowdown, but the balance sheets are in a great shape. Raamdeo, tell me, relative to any period that we have seen in any bull market, this time balance sheets of both the corporate India as well as the banking sector, financial sector, the government sector. There is a small part of, I would say, household sector which has got over leveraged, maybe some of the unsecured personal loans, etc.
That the RBI is trying to solve.
Exactly. And you have to give credit to our regulators, how conservative and how prudent they are.
Let's do one thing. We have a fantastic track audience with us. So we have the entire global thing to discuss, which we will do, but let's also open it up to questions. Nilesh?
I would like to ask questions to both the guests. It's Diwali time, we talk about wealth creation. You give a nice setup on the top down, where India stands in earnings and everything. But Raamdeo, I want to ask you, for the benefit of the viewers and new first time investors, how do you identify a big winner like Trent? I'm asking this because, I met a very senior fund manager last week, and his biggest regret of this year was to not buy Trent. I believe you have in your fund as well. The stock has done phenomenally well. It's always been expensive. So, because you've seen so many market cycles, how do you identify a winner like Trend and ride for very long time?
Stock tip chahiye yaar, Nilesh ho gaya.
Next Trend.
You have to one of the things you need for this kind of stocks to come through is to find a tailwind, massive tailwind. See, what happens is, markets don't know where the tailwind is going to come up. Say, energy sector, it was dead. Suddenly in last 12 months, energy sector is thriving all over. I mean, historical IPO just about closed yesterday. I believe 250,000 crores have been kind of put in the demand. So clearly it is backing the tailwind. So you have to find a tailwind where tailwind is. Like capital market has a tailwind. 4 million customers are coming every month. So you have to find who are the beneficiaries of that tailwind. And then go and buy.
One person is sitting next to you in terms of benefiting from
so everybody is, so you have to figure out like energy transition. So you have to find one tailwind. See, what has happened is Buffett and all has taught us, and he has over-taught kind of thing. So what has happened is this quality buying, good franchise buying, but what has happened is that in the last 25, 30 years, globally, these companies have become exorbitantly expensive, and they are not growth companies. So if you have 70, 80 P multiple and 5% growth, how will you make money? By no mathematics can you make money. Okay, but it looks very nice on your Nestle, Lever, and I don't want to name too many. So, but so these names are not going to make money for you. You have to find the one where the tailwind, you are early in identifying the tailwind. And you bet on that. So like, I'll tell you now past. So like, I remember buying Bharti Airtel in 2003. So at that time, there were no phones. In India, there were 40 million fixed lines for this country, a billion plus. So the phone was absolute dire need. And then these guys, they come, they grow like 5-7% month on month. That kind of growth. But it was not making money. So they came out with IPO at 45 bucks and quickly it became 19 bucks.
Yeah.
Okay, you could buy entire Bharti for 5,000 crores.
Yes.
So I was lucky to identify that yes, this is going to be a growth sector. I bought it for doubler. My always intention is to buy a company which will double in 3 years.
Okay.
Okay. But it turned out to be 25x.
Yes.
So now I can say I bought a multi-bagger. No. It turned out to be multi-bagger. So you never buy a multi-bagger to start with. You buy as a healthy investment and it turns out to be, the tailwind turns out to be so big that you end up getting the kind of a trend kind of a return.
HDFC FlexiCap Fund, it's multiplied 200, it's multiplied 200 times, close to 200 times in the last 30 years. And of course, I must say that mutual funds are subject to market risk. On a serious note, past performance is no guarantee of future. But what it shows is the power of compounding. What it shows is the power of an Indian economy where we are so lucky, where the economy has been growing at a decent pace. You have a corporate sector which converts that growth into their revenues and profits. You have a stock market which converts that into the returns for the minority shareholder. And you have a mutual fund industry where with 500 rupees you can participate in the same growth. This is phenomenal. This has happened only in the United States and very few countries.
No, there are only two countries.
Many countries.
There are only two countries which are compounded. India and America.
Exactly.
Yeah.
There is no other country. So there are more failed countries on this count. Then, so if you don't invest here, go to US, otherwise don't go anywhere.
I think long-term returns are dollar returns are 12%, both markets, right?
I think so, more or less.
20,
but it's a compounded return. It's not a jerky
Compounded.
one.
Exactly.
That in 1 month you go up by 30% and then next 30 years you don't do anything.
Yeah.
It's not that kind of market. I mean, the market makes new high almost every year here. I mean, even if there is a massive breakdown, in a year's time it just comes back.
Yeah, no,
So
absolutely.
that kind of compounding has not happened anywhere.
I think that's an emphatic
We're
statement.
talking about 15 days of correction and maybe a quarter of earnings slowdown. I mean, we have handled much bigger challenges
Oh, yeah, I
in
mean-
25 years when all of this has compounded. Yeah.
I think Hormuz, you want to ask a question?
Actually, I wanted to ask both of you gentlemen, for a better part of 2023 and for the earlier part of 2024 as well, right? Everybody was talking about one sector, that was the PSUs. Everybody was talking about PSUs. Every day you would see stocks go up 6, 7, 8, 10%. Now that these stocks have corrected 30, 40, 50% from their peaks, and some of them have corrected by that extent in just 2 or 3 months. For a first-time investor, sir, you mentioned that most of the participants in the market who have come post-COVID have not seen a cycle like this. They've not seen a 2008, they've not seen a 2017, 2018 kind of a mid-cap, small-cap meltdown that they've seen. What would your advice be to such kind of an investor who would look at a past performance saying, "Ke haan, ye to 2 mahine mein double ho gaya, 3 mahine mein double ho gaya," and then you see the kind of fall that you see? It's very easy to get disheartened, right? What would your advice be to such kind of a participant and a sector like PSUs now? Do you think that a 30, 40, 50% correction has now made valuations healthy?
No. See, I know PSUs have been disaster for 15 years, 20 years. From 2005, they were the commanding heights of India. In the stock market, they were commanding heights. 40-50% of market cap used to be PSUs. Then it became literally nothing. Wealth creation was literally zero in 22, 23, and then this thing happens. And it was crazy. I mean, it was completely unreasonable where the valuation had gone. 3P, 4. Coal India, I think, was low single digit, like 2, 3, 4P, 40-50% ROE, payout of 9-10% yield. So clearly, as if the coal is going to stop, I mean, like next 12 months. And he was not able to supply coal. Even now, there are shortage of coal. So I think the markets have the tendency of the whole crowd somehow, there is a problem with, any markets, that they come together and they make a theme very, very unpopular. It's a myth. So the guys who made money, obviously the guys, they didn't buy into PSU. They had PSU somehow. And then the whole thing reversed and they made money. Now you deliberately go and buy PSU at some good price. I don't think that is going to make money. I mean, you have to find your own way of making, but it's not a generic call that you can make money out of PSUs.
You know,
As a house, we have benefited a lot.
Yeah, they were the guys who were
some of the
sitting.
PSUs that we had with conviction for a very long time, I think they ultimately turned out to be very, very good. A lot of credit to the government for bringing in the operational efficiency, the capital efficiency that over the last couple of years that has been brought in and which is reflecting in the market. But at the same time, the whole, I mean, it's not a sector because I think companies are in different kinds of businesses. But again, there were pockets where because of the low floating stock, a lot of euphoria and maybe the narrative got ahead of the fundamentals. Prices reached a level where there was no way incremental money could have been made. So it's good to see some bit of correction there.
Now, let me welcome another set of stars who've joined our galaxy. We have Mr. Nilesh Shah from Kotak AMC and Naren. Thank you very much for joining in. We want to hear more from you as well. But if I could just extrapolate that question on PSUs, Hormaz's question, to I think a larger issue that a lot of investors, mutual fund investors, would be confronted with today. They're seeing the value of their investments erode. Now, human tendency would be that even if I don't need the money, my God, yesterday I was up 50% on my 2-year return or whatever, and today I'm up only 30%, tomorrow it's 25%. So the tendency seems to be, should I just book profit right now? So Navneet, what's the advice that you'd want to give to this very genuine question that I think a lot of mutual fund investors would be having today?
That should be book profit because
you're seeing the value of your portfolio fall. You don't necessarily need the money, but you want to feel smart, like I've preserved my gain, right? And then you don't want to.
After that, I mean, you pay tax now, you put that, and then maybe you wait for the correction. And it's very, very difficult. I think all of us over the years, we have heard that, we have told people that it's the time in the market. May sound like cliched, but it's the time in the market, not the timing. I think none of us have been able to do that, and I don't think easier said than done.
Yeah.
Let me give you a nice quote here. Patience is bitter. But fruits are very, very sweet.
Ah, nice. Yeah, that's
a better one.
So,
that's a good one.
I mean, you have to bring patience to investing. You can't be always all-time high, and all the correction has to be in my account, isn't it? That's what So, who's going to take the correction?
I'll give you an example. So, someone called me and said that, retail investor who's also into direct stocks, said that I bought HDFC Bank because it's supposed to be a long-term fundamental good bet, right? And it's falling right now, but it'll do well. So, that's my thought process. I said, good for you, congratulations. The same person sort of calls me again saying, I sold HDFC Bank because I was hearing that they have some structural growth issues. Next couple of quarters will be difficult. I sold it, but now it started rising again after this quarter. So that's the kind of trap that people get into, even though they want to be, fundamental investors.
I just want to warn people about one thing. So in February 20, we were here when we touched that high of 12,000 on Nifty. In next couple of weeks, we fell to 7,700 by 24th March or so because of the COVID. And from April onwards, what happened that as markets started recovering, we started getting redemptions because people had this psyche that I've seen the fall from 12,000 to 7,700. As it went to like 9,000 and 10,000, people thought, let me lock in my gain because still we are hearing about COVID and whatever the impact on growth. But all of them have missed out on the big rally over the next 3 years. It's very difficult to time it.
Just one thing I want to ask. We are not in a 2000, was it 18 or 19 when mid caps and small caps kind of topped out, and then we didn't do anything for the next 3-4.
18, yeah.
18, right? It was January of that year. Raamdeo, any thoughts? We will only know in hindsight, but that was a top, and then for next 3-4 years, absolutely nothing happened, right? 4 years, mid caps and small caps.
I don't remember, so actually I can't say anything.
But do you think
I was fully invested at top of the 2008. And at the bottom also I was fully
invested. 2019, right?
19 you're saying, okay.
Yeah.
Even then I was fully invested. And I've done well. So I can't figure out why.
That is the answer then.
That's the answer. Yeah. That's how long-term wealth is made.
Any thoughts?
No, I mean, the investors will become more discriminative. I think, as I said earlier, that in last couple of quarters, everything goes up. Good news, not so good news. I mean, good result, not so good result. But market just goes up. Stock just goes up. I think it will change now. And people will start looking at the fundamentals again, which is a good thing. Even now, after the correction, there's part of mid and small caps where there's still froth. I mean, even at this valuation, they haven't become so attractive that you just go close your eyes and go and buy. I think so. It's good that sanity is coming back.
Nilesh?
Raamdeo, you spoke about identifying a tailwind, and I believe you've turned very bullish on the new age businesses. You personally invested into Zepto. Your private equity owns Swiggy. Your fund owns Zomato. What's the view there? And I'm going to toss it to one of your colleagues as well, who's going to manage the digital strategy for Motilal Oswal AMC. But your first one, then I'll go to him as well.
Yeah, so I fundamentally believe that when anything goes digital, see, we have seen it very closely. In 87, the total transaction in stock market was 200 crores per day. Today, and settlement was T+15, and we used to labor to settle that. Today it is 400 lakh crores per day.
Okay.
There is no industry which has grown at 2 lakh times in 30 years.
Yes.
Okay, so that is possible purely because of technology and digital.
Yeah.
Okay, and it is still growing at 50. In fact, regulators are scared of the growth of the industry. So much so. So anything goes digital, it just goes wild.
Okay.
Okay, so now grocery is going digital.
Yeah.
Your food delivery is going digital. Everybody is a consumer. I mean, you can see in your own house, there is actual consumer behavior change and intense.
Okay.
And these are not small categories. There are $1 trillion categories. And how many guys? 3 guys at early stage. So you have to, and it's not only about them. All the digital business, whether it is in payment, whether it is in insurance, whether it is in navigation or whatever you say, anything goes digital. I mean, how many times you see your map when you are traveling for half an hour?
Absolutely.
Otherwise, who's going to tell you where is this particular place?
Right.
So I think the use of digital. So my sense is that like what is happening in US and China and all, I think the number of digital companies in India are going to explode sector after sector. And I don't know which one will go 100x.
Sure.
But if you have the full bucket of 15-20 companies, the entire bucket will go up by maybe 25-30% in next 10 years.
Let me go to one of your colleagues. Varun is here. Varun, thanks for joining in. You've done a lot of work on the digital space. If you want to just quickly run through your thesis and some big numbers on why you feel it's an opportunity for the decade.
Yes, sure. See, Raamdeo ji has covered most of it.
Yeah.
But we are seeing digital coming in each and every sector, right? We saw these trends in the US, we saw these trends in China. India just lagged behind, but we have all the digital pillars in place today. So when we are looking at next 10, 15, 20 years, we know that digital companies are going to emanate from each and every sector in various constructs, be it B2C, B2B, or even B2B2C. And that is something that we are, banking on right now, that this is a big tailwind, like just like what, Raamdeo ji talked about. And possibly this is going to be the biggest tailwind across sectors over the next 10, 15, 20 years.
How big could be the TAM? When you talk about total addressable market, how big could be that market on the digital side?
So currently the numbers that are coming out are, currently we have about 8% of our GDP as digital, and very quickly over the next 6 years is going up to 20%. Oh. And it's not going to stop there. You can imagine, this penetration is going to continue to happen.
Can this happen, Raamdeo ji? 20% of GDP coming from the digital companies?
It looks like big, but compounding is always very mesmerizing, particularly 10 years, 20 years, what it can do.
Okay. Varun, you want to add anything else?
Absolutely. I think it's quite fascinating that we are seeing so many new companies, smaller companies, which are gaining scale phenomenally. And we're very excited for the next few years. We'll see many more new companies coming out and get listed. Exciting times for us.
Okay.
I want to take that point forward actually. The fact that you mentioned the penetration that is growing exponentially when it comes to digital. 2 other sectors which are in similar categories, not digital exactly. One is financialization of savings that you just mentioned. The number of demat accounts, the way it's growing exponentially, but the penetration is still not as to that level that you would think, okay, it's a massive sector. Same for insurance, but insurance, even after so many years, it's not managed to reach that level. Do you think AMCs or this financialization of savings as a theme would be a faster scaling theme compared to insurance when it comes to penetration exposure?
Yeah, I mean, see it's a savings product. This one is entire savings product. So what we have seen in broking and all, I mean, the moment it has gone digital, the ease of boarding and participating has become far easier. And see, one broking account, my broking account could be worth hundreds of crores. Okay, but my insurance account will be only that much. How much premium can I pay? So that opportunity size is my total savings. If I am worth 1,000 crores, my entire 1,000 crores is available for trading and wealth management and asset management, all sorts of things. But insurance is not like that. So TAM gets slightly distorted when it comes to entire capital market, and that to digital.
We're talking all the big stuff, and that's what we should do, right? Look ahead, and but slightly near term. I want to just ask you, Raamdeo ji, how much more?
Huh?
How much more on the downside? You think?
Downside?
7% market has fallen. Nifty has fallen from highs. How much more? Will we be higher by next Diwali? You think?
Next Diwali for sure. For sure will be higher, but how much higher I don't know. But these things are, see, first thing is nothing to do with India.
Right.
It is to do with what happened in China.
Right.
China did a stimulus and people got excited about it.
Right.
They might again be disappointed. What is there? And then people will run from there to here.
Correct.
My problems are my own earnings, so that we must address.
Correct.
We can do nothing about China's stimulus.
Correct.
So I think that's a temporary phase. We have to pass this time, and what I was, just think the day on which FIs become neutral or positive on India, what happens?
But do you think it's possible we are in a bit of a time correction phase? We flatline for a while? It's possible?
I mean, don't ask me like a chartist, I don't know. I've never seen...
Have Chandan writes there.
Chandan is there. You ask him, he's the guy. Actually, he's the guy. I mean, he spends 24 hours looking at charts.
No, we will bring him in as well. But do you think the market does nothing for a while? I mean, the go-go markets we had, the euphoric markets for the last many years, that we kind of temper a little bit.
Pace of 15% is on. Last 5 years is only 16% return. Let me tell you. Nifty return is just about 110% total for 5 years.
Okay.
That is about 16%.
Yeah.
I don't have any problem in saying that it could be 100% up in next 5 years.
So,
and in next 10 years, for sure, it will be 4x.
So market is going to double.
Yes.
In
5 years.
In next 5 years. So you.
That is my expectation.
That's your thesis.
That's my
yes.
expectation. I mean, who knows?
All right.
I guess with that, we'll wrap up this part of the conversation. Thank you so much for joining in and, shedding some light, in the festival of lights on how we're looking at wealth and our investments. Well, we take a very quick break, but don't go anywhere because on the other side, we have Nilesh Shah as well as S. Naren joining in with their thoughts on how the market is placed.
Please, please, sit. Guys, let's start. Guys. Welcome back. You're with us here. Sorry. Well, you're with us here on the Diwali Market Movers Forum, and we are in conversation with some of the top experts. Lots of questions, as we just told you. Let's welcome S. Naren, boss man at ICICI Pro AMC, and Nilesh, boss at Kotak Mahindra Asset Management Company. They're both here. Gentlemen, please join us on stage. Thank you so much. Wishing both of you a very happy Diwali. Thank you so much for being here with us here at CNBC-TV18.
Wish all the viewers of CNBC-TV18 a very happy and a prosperous Diwali.
Wish all the viewers and all of you happy Diwali.
Thank you very much. Naren, let me start with you, because you've been for the longest time sort of calling for a bit of a sort of tempering of expectations, and the run that we've had in markets, we've finally gotten that at the margin a little bit. Are you satisfied or not yet?
No, it's not a question of satisfaction. I don't think we want investors to lose money because markets come down. That's not the case. See, basically what worries us, we are managing public money. So our job is to temper expectations. And that too, when you've had long periods where markets have not fallen, there are so many investors who believe that equity is like FD. And then, that worries us a lot. So that's why I think it's our job actually to temper expectations, particularly when expectations are going up and when markets are going up. See, particularly after March 2023, what happened was most investors wanted to only invest in equity and not invest in debt. And therefore, what happened was this cycle became more and more positive towards equity. And we could see over the last 3 to 6 months that first the challenge is that there is nothing wrong with India's fundamentals or something. So it is basically a valuation problem and a sentiment problem. That the sentiment problem is you have all these SME IPOs, you don't know what they have internally, and you have a situation where companies whose balance sheets are weak, managing to raise money, any amount of money in the equity market, that worries us. But we can't predict markets, so it's our job to
Let me clarify when I say satisfied, I did not mean that. I just said that is it enough tempering of expectations, or you think it's going to be an ongoing thing?
Yeah, you know, if for example markets had already become a level where you know, things had become cheap, we would we would move out of our call to keep on talking asset allocation and multi-asset and all that and move to equity. It has still not happened. Because if you look at where markets are, or look at even 1 year returns in small cap, mid cap or large cap, it is not low, it is still high. Maybe the markets have corrected in the last 1 month. But they have not. If you take the 1 year returns, they are still high, and the valuations are not cheap in any sense of the word. So that's why it's still not in a situation where you can come and tell people invest aggressively at this point of time. That phase is not yet started.
Nilesh bhai, you and your team have also been sort of ringing the caution bell for a while. I remember, I think you were also one of the early ones. Are we in a bit of a corrective phase which is likely to last a little bit? What's your sense?
So I wish I knew about the market like that. Otherwise, I would have said 1 month back only that now market will correct.
Right.
We know where the valuation is. Is it cheap? Is it expensive? Markets is like pendulum. Kabhi idhar, kabhi udhar. So I have no idea where markets will go. But I know now valuations have corrected in many cases. And it's time to look at stock on a bottom-up basis.
So we started the month with about $16-17 billion of cash across the mutual fund industry. At Kotak, have you already deployed quite a bit of the cash?
So we never took cash call and we communicated that to our investor. We believe my partners are taking asset allocation call for their client. If I try to second guess them, then we'll end up having, wrong sequence. There are funds like multi-asset allocation fund or a balance advantage fund or asset allocation fund, where we have taken allocation call between debt, equity and gold, silver. There is some marginal increase in equity allocation from, let's say, gold or fixed income. But that's marginal, it's not material movement.
Mm-hmm. Well, Naren, just to build on to the point that you made about FDs versus equities, right? For the last couple of years, it wasn't even an option. But going by the euphoria in the system, by the valuations as well, would you not rule out that, say, in the next 12 to around 24 months, actually a fixed income could outperform a mid or small cap fund? Could that be a possibility? Because the index itself has moved up by 3 to 5 times in the last few years.
It could be a possibility, but if you ask an average investor, the average investor is still very pro-equity at this point of time.
Right.
See, because you're not, you have to look at a 10-year history.
Indeed.
All the way from 2014, there has not been a down year. So, if you ask a typical investor, the typical investor is today not interested in debt or fixed income. The typical investor today is interested in equity. Mm-hmm. While we believe it is quite possible that FD can outperform small and mid cap, most investors today are really happy with equity as an asset class.
Indeed.
And that is the reality at this point of time. The challenge is, if you add a fundamental problem and valuations being high, it would be very easy for you to say that this would happen.
Right.
Today, you don't have a fundamental problem. You have a valuation and sentiment problem. And valuation and a sentiment problem is something that you can have situation where valuations can be high for a long period of time.
Indeed.
That doesn't mean that we are going to thump the table and say, put all your money in equity, because our goal is we manage public money. We don't manage our money. So our goal is to reduce investor expectation and try to get people to moderate their expectation and try to get people to invest in all asset classes and not take only risk. Because when they lose money, they tend to think that we are responsible for the losses. We are not responsible for the losses.
Right.
We are responsible. If people give us money in small cap, we'll invest in small cap. If they give money in mid cap, they will invest in mid cap. So our goal is to reduce investor expectation. Are valuations cheap today? I think barring banks where the valuations are reasonable, most other sectors are still not cheap. That we can give a positive.
So from a 5 to 10 year perspective, obviously equity is in the way, but maybe in the near term, fixed income could outperform just in the near term going by the valuations. Just one
There
more.
is one fixed income instruments which will outperform small and mid cap. The 50-year strip, if you can lay a hand on it. The 50-year strip will have 50-year duration, and if interest rate comes down by 0.5%, it will give you 25% return.
Wow.
So one fixed income instrument I am quite confident will outperform small and mid cap.
Is it difficult to get your hands on?
Because it's difficult.
But it's available?
It's available, but it's difficult to get because the long bonds are all with insurance and pension players. They don't sell in the market. But theoretically in Indian market, we have a fixed income instrument which will outperform small and mid cap over next 12-18 months.
Interesting.
All right. Naren, just one more point, I think you're not attributing this nervousness more to a fundamental problem or the economy is slowing down. It's more the euphoria that's built up in the system. That's the bigger problem, it seems.
So you had a euphoria. You have some amount of euphoria. On top of it, you had fair amount of IPOs. So you had a situation where the fundraisings had started to accelerate. So you have a situation, on top of it, you had a situation where the FIs wanted to sell India to invest in China. So the combination of the three has resulted in it. It is actually, if you look at it, the biggest reason is what China did. That Chinese stimulus, the FIs were caught underinvested in China in a very big way.
Right.
They thought that China is a place where they don't need to invest for the next 5 to 10 years. And the valuation, if you looked at purely from a valuation point of view, China was at 9 PE.
Right.
But the problem was people were saying, no, we don't want to invest in China because China has deep structural problems. But when the stimulus was announced, most of the hedge funds, most of the foreign funds, they were caught napping and they found India is the best place where valuation was high. They could sell the market. They could even execute their sell trades. Maybe in some of the other markets, they couldn't have executed sell trades. So they went and executed the sell trade.
Okay. All right, Nilesh, let me get you in on this. The domestic flows have been rock solid and this equity cult has been built in India, and a lot of us are part of that. Could you tell us, according to your estimates or your analysis, how much of this FI selling is done? Because the broad outlook was $12 to $50 billion could be the readjustment that could take place because China has come back to life. Do you think the FI selling bulk of it is done? And also the domestic flows, they've shown the fatal now, which is very, very heartening. But how do you see that shape up?
So let me first contradict this statement that people are overexposed to equity. As per RBI's data of Indian financial sector allocation of Indian household, between FY21 and FY23, total money which came into mutual fund was 4 lakh crore. Total money which went into capital market, including bonds, debentures and equities direct, was 2 lakh crore.
Okay.
So, कुल मिला के 6 lakh crore आया. The increase in currency in circulation was 9 lakh crore.
So, yeah.
9 lakh crore is in currency notes. I haven't got that money in equity yet.
Right.
93% savings of Indian when they invest in financial sector is negative real return or marginally positive real return. Where do you go and put money? Bank deposits, insurance, pension, currency notes and small savings.
Right.
You want to secure financial freedom, but you are only putting 7% of your money in real return product. 93% wealth does not create any return for you. How will you become wealthy?
Indeed, there's a huge scope for penetration here in India.
So in the domestic market, there is huge scope for penetration of real return product. It could be equity, it could be performing credit, it could be alternate, and all those things will come over a period of time.
Mutual fund sahi hai.
Mutual fund sahi hai because this is one product where manufacturer, distributor and investor interests are aligned.
So the
in some industry, it's tilted towards manufacturer and distributor. In some industry, it is tilted towards investor. But this is the only industry where everything is aligned together.
Right.
Now coming to China, how many investors would like to invest in a country where you don't know where their ex-defense minister and foreign minister are? Today we have no idea where China's defense minister and foreign minister is disappearing. How many people would like to invest in a country where last 10 years earnings growth in terms of CSI 300 index EPS is 10%? In renminbi terms, 1% a year. In the same time period, India's Nifty went up by 166% in EPS in rupee terms.
Right, from 400.
So on a price to earning basis, yes, India looks expensive.
For a reason.
Obviously, and on a price to earnings growth, we are looking far more cheaper.
Yeah. No, absolutely. And maybe because we kind of, there's a little bit of adjustment which is happening, and that's okay.
ठीक है, सुबह का बुला शाम को घर लौट आएगा. कहाँ जाएगा?
That's a nice way to put it. You're a Naren, close watcher of macros, right? First of all, do you have any views on this? How much is tactically shifted? Is it mostly the bulk of it is done?
You know, people can say that they know when FIs will stop selling.
We don't know.
FIs is not one broad single group.
Correct.
There are hedge funds who wake up in the morning, short India, evening wake up and buy India. So these things no one knows actually.
Okay. What's the big dominating global stories? Because you're a close watcher of the macro cycle as well. What's going to be important to watch in your opinion?
Clearly the US election. And we don't know what policies will be followed depending on who comes after the US election. It will have some impact. So if the real challenge at this point of time is India has had fantastic macro. So if you look at the most important indicator being current account deficit, then you look at fiscal deficit, particularly central government and inflation. We have managed to keep it very stable. That's why Indian 10-year, the Indian government yields haven't gone up in the last 3 to 5 years. But look at the US situation. It is quite possible that after the US election, all of them will increase the US fiscal deficit. Then what happens to US yields? In fact, US 10-year yields have been going up, US 30-year yields have been going up. So what is going to be the macroeconomic impact of the US election? That is something, surprisingly 10-15 days before the US election, there's very little discussion on that, and it may have fair amount of macroeconomic implications on India. It's possible that the FIS sold India just to keep some cash for the uncertainty to deal with the US election. We wouldn't know it, and it may come back after the US election if they realize that there is no negative impact on emerging markets. Maybe that is the reason. That is clearly one clear thing. Second is geopolitical. We have seen 2 wars. Virtually the second is also like a war only if you see what's going on. Can that escalate after the US election? Because has the US government tried to persuade Israel not to escalate it ahead of the US election? We don't know that. So that is another important issue because oil has been very well behaved. If oil spikes up substantially, it has negative macroeconomic implication. That is the second, if you look at it. The third, I think SEBI has been correctly pointing out that the entire enthusiasm for the derivative market, which is there among local investors, is the third big macroeconomic thing. While the Indian government has managed macro very well, the extent of enthusiasm shown by the investors in the derivative market is a bit of a worry for the regulator. I think last week one of the members in television mentioned it has become a national pastime and it should not be. I think that is a real worry.
That has been addressed now, right? With the last...
it doesn't get addressed.
The weekly contracts, etc.
If the amount of activity still remains high... And
we will know once all these changes take effect, which is on the 20th of November.
Place, but even today, as we speak, how did the quantum of selling get absorbed? A lot of it has been absorbed by the derivative traders in India at this point of time. If you look at the open interest in, the entire people talk about how SIPs will save the Indian market, but the level of SIPs is much smaller than the amount of leverage which exists in the derivative markets in India. So I would say that is the third worry. So these would be the 3 things that really worry me at this point of time. The third is something I think continuously SEBI has been pointing it out through research papers, through interviews, in various ways. So I would say these are the 3 things.
Well, Naren, give us a couple of themes. When in your introductory remarks you mentioned about banks. That could be a sector that at least is reasonably valued, the large private sector banks. which haven't really run away in the last few years. Would that be a sector that you'll be reasonably optimistic on? On the broader markets, you're sounding a little bit cautious, with good reason. But would banks be a theme that you would look to play?
Certainly, because what has happened is that FIs in their index had a very low weightage to banks, because one of the big component of the bank was not even in the benchmark in a big way. That got addressed partially in August, it will get partially addressed in November. So once the November change in weightage happens, in their benchmark, the weightage of banks have gone up substantially. One of the biggest problems was somewhere in the last 4-5 years back, instead of buying Indian consumer stocks, I think the foreign institutional investors bought banks. And they got very over-invested in banks. By the time the November change in benchmark happens, they would be no longer over-invested in banks. So the reason why banks didn't do well was not because of fundamental reasons, but because FIs kept selling banks. So I think that issue should be over by November. And after that, we don't have this worry that FIs are very over-invested banks. So I think that makes it much easier at this point of time. You have valuation comfort. You no longer have over ownership of FIs. You don't have over ownership of locals. So, and you have good fundamentals, reasonable governance. So I think that's a sector to look at this point of time.
All right, Nilesh, you come in now. In terms of sectors and themes that you think will look up from here on, give and take everything, valuations, earnings, ownership. What are the couple of sectors?
So one, quality over momentum. Now your definition of quality and my definition of quality can differ, but by and large what you consider quality. Second, high floating stock market discovered prices over concentrated holding. ये भाई का stock, वो भाई का stock, वो भाई के पास ही रहने दो. तीसरा, reasonable valuation over expensive valuation. If you see by and large banks, IT, pharma, telecom, auto, cement, these are the sectors where you will see some stocks which are reasonably valued. Capital goods, defense, railway, consumer durable, these are the sectors where you will generally find stocks are a little bit aggressively valued. And then there is one market where you don't go because you don't understand the micro caps, the mini caps, the SME index. I believe in that market some stocks have fallen, almost 40-50 stocks have fallen quite sharply. But despite that correction, I still think it's risky to venture over there. So focus on quality over momentum, high floating stock over low floating stock, and reasonable valuation over expensive valuation.
Nilesh, I wanted your view on this consumption theme that, the commentary that's come in HUL, Nestle, Tata Consumer, all of them are sounding very, very cautious. And the numbers that came in from the two-wheeler majors, Bajaj Auto as well as TVS Motor, both of them disappointed. How concerning is that?
So one, as we speak, festival season is picked up. And in this 40 days between Dussehra to Diwali to Christmas, almost 40% of two-wheeler sales happen. What we have heard on the street, volumes have picked up, but so has the discount. If you want to buy car or a two-wheeler, today is the best time to buy because you will get all the good terms. Undoubtedly, there has been some slowdown in economy. Cement sales, auto sales, petrol, diesel sales. These numbers have come subdued and soft. Is it because there was Shraddh period? Is it because there was rains? Is it because government didn't spend during election cycle? Or is there something else?
Yeah.
We'll have to really observe this festival season. If consumption bounces back in this festival season, then chances are that the momentum will be carried forward as monsoon has been good. Kharif crop and Rabi crop both should be bumper this year. So you have to be careful, you have to observe data. But in the consumption side, please remember that the consumption is now coming at the Gen Z and millennial level. Many of these established companies are banking upon their brand to get the customer. But the new customers might be moving to some other brand.
There's a disaggregation also happening.
I mean, if you go to a retail store, it's no longer necessary to buy a global MNC company's Cadbury or chocolate. You can get as good quality chocolate at half the price from a local manufacturer. people are becoming value conscious. As Maruti Suzuki advertisement said, कितना देती है? वो अगर आप नहीं देंगे तो consumer आपके पास नहीं आएगा.
Naren, on the slowdown bit, you're not so sure, right? That there's a
See, first was there are festivals which got postponed. Then, you have to look at the fact that this year we had a much better monsoon. So August, September was certainly affected by monsoon. So when you have a very good rains, the activity level in August, September gets affected. So I'm not very sure whether the slowdown bit. I actually think, I really worry that this big equity boom, people are investing more in equities rather than spending in anything else.
We were just having that conversation with Raamdeo ji and Navneet earlier, and they were saying exactly the same thing, saying that SIP will not stop, even if you stop reduce consumption somewhere else.
And भाई मुझे तो आपकी जेब में जो पैसा पड़ा है, आपके घर पे जो पैसा पड़ा है, वो म्यूचुअल फंड में लाना है.
But you think
4 lakh crore, how can it be a big amount? Currency in circulation is double that of. And last time आपने कभी पैसे को छुआ था, you are working on your credit card or mobile phone.
But there's a lot more to come. Yeah, please.
But you look at any IPO today, there's an IPO which closed yesterday.
$30 billion.
Look at the amount of money. So you're saying money is not there, but look at the amount of money that came into that IPO. So I feel, somewhere what has happened, it is delayed monsoon, some of the festivals getting delayed, and too much enthusiasm for stock market is also delaying expenditure. People are saying, let me keep
delayed gratification.
Delayed gratification.
I can give one example. Nigel, am I allowed? And this is on national television. It's already happened. Our good friend and co-host here, we were having a discussion on diamonds. And Nigel has said that I will never buy diamonds. I would rather put that money in SIPs. So,
Nilesh bhai, I'm practicing whatever we talk.
Absolutely.
I don't put 12
The diamond curve is like this. Market curve is like this. So,
but talking about that, what about asset allocation? Gold has done very well. In the last 1 year, everyone's talking about the equity market being up 25%. Gold is up as much, I think 22%.
Silver has outperformed Bitcoin last year.
Indeed. So I wouldn't touch diamonds, but allocation to gold, whether it's the sovereign bonds or some other form of gold. But what would your asset allocation be at this juncture?
So each one to his course or her
What would you
course.
recommend?
I'll say in duration, try to in fixed income go longer duration, and maybe next month or so when US yields are rising, you'll get a good opportunity to invest. On gold and silver, we still believe it's time to be overweight despite this run-up. Of course, there will be ups and downs in gold and silver, but eventually, if central banks of the world are becoming like Indian housewife, buying gold and never selling, gold prices has no option but to go up. In silver, supply is getting restricted and demand is very strong.
Yeah.
So those prices also remain supported. And on equity also, maintain your neutral allocation to equity. It's not a market to be leveraged or over-invested, but at the same time, don't become underweight because they have corrected in last few days. It's time to maintain asset allocation as per your risk profile and be honest to yourself. If you bought during COVID time, that means you are a risk taker. If you sold during COVID time, then you are a conservative guy. And if you didn't do anything and just let your SIP continue, then you are average risk taker. Don't be dishonest with you.
Naren is a big believer in asset allocation, and you've been saying, right, you've been saying flexible funds which allow you to kind of move freely between various asset classes. That's the way to go still?
Yeah. But today, see, the challenges at this point of time, which are the places where there's fear? Globally, there's fear in office assets. So that's why we like if somebody, because anything to do with offices have gone down substantially globally because of this work from home. So that's one area of fear. But otherwise, across asset classes, there isn't fear. Your 10-year yield in India is possibly much lower than gold, silver have gone up. Everything has, residential real estate has gone up. So one of the challenges at this point of time, there are no pockets of deep value at this point of time within India. I mean, if you find a way to invest in some other countries like Brazil, market hasn't gone up for 10 years. So they must be having their problems. But I'm just saying that at this point of time, there are not too many asset classes with fear at this point of time. That is the reality.
Let's bring in Nimesh as well.
So
Nimesh.
I want to ask both the gentlemen, something which is close to your heart. I'll start with Naren first. We've always seen you, heard you as a contra investor. And whenever I've heard you or I've met you, you always given one or two contra ideas. From this Diwali to next Diwali, if I want to ask you, if you want to stick your neck out, what could be your contra bet? Whether it's a sector bet or a asset allocation bet, what would be your top pick?
So actually, what we've done is that we've certainly seen banks as a bet. So if you look at some of the strategies that we run, we have much higher banks than we ever had, private banks than we ever had. So I would certainly see that. And certainly we have more cash in our funds than we had. So if you look at it, because we went through a debate, can we have cash? And we said cash can be, it involves risk. I don't think the cash in the portfolio is low risk because finally you're comparing yourself against a benchmark. So I would say that we did have cash. It doesn't mean that we are negative. It means that we said that what could be contra at this point of time? Can you show me something which is contra? I couldn't find. So we said, let's have some more cash.
So bank and cash is your contra bet for next year?
At this point of
cash in the bank.
But cash. And so that's why, my colleague in the company said, let's look at where people are not willing to invest from outside. They said offices. So that was one area.
Sure.
So we keep thinking what can be, but it's been such a difficult task to identify contrarian assets in the financial space at this point of time.
That's a statement from Naren. Nilesh bhai, whenever we've met you and we've had you on the channel, you've left us with some headline. I'm just looking for one big headline from this Diwali to the next Diwali. What could be that one headline from Nilesh?
पिछली दिवाली से इस दिवाली गधे और घोड़े दोनों दौड़े and गधे ran faster than horses. इस दिवाली से अगली दिवाली घोड़े दौड़ेंगे गधे नहीं दौड़ेंगे.
That's a big one.
That's what I love about Nilesh. You always have a nice punchline ready for us.
Put it quality over non-quality.
Quality, yeah.
Quality over non-quality is something I fully accept.
And I think it started visible, right? We saw momentum losing out, the value losing out. The PSU index is down 12%. Stocks are down 40-50%. The mid-cap and small-cap have started giving up. And what's working is, as you rightly pointed out, banks and especially banks per se, the numbers also not been that bad.
But
so
if you look
like that shift is happening.
If you look at FMCG kind of sectors are also some things which we have started to look for from a contrarian angle because some of those stocks have not delivered now for 4 years.
Absolutely. Yeah.
At this point of time.
But talking about PSUs, select names have been positive on and the index itself has corrected a whole lot. Do you still think there are themes out there because the entire market capitalization went from 15 lakh to I think 80 lakh crore and then from there we saw that correction?
But we lost enthusiasm in PSU as a theme some time back because as Nilesh pointed out, the most illiquid PSU started to go up substantially. So that's why, we have not been talking too much. In fact, if you look at our portfolios, I would say they were managed very well and that's the reason we made money in them. But they're no longer as attractive as it was. And thanks to the good work done by many of the PSU managements,
Indeed.
along with the government. So if you look at it, their dividend yields are better, their balance sheets are better, they have not done stupid things. So everything has been good. But due to that, as a contrarian, I would say I was forced to sell them.
In fact, we have gone to the government and said, please do divestment and raise money. This is the best time to get your value.
Absolutely.
I'm glad you brought up that point because that's just the one thought that I wanted from both of you. This has also been the year where we've seen a massive amount of paper come into the market, right? IPO, secondary sales, promoters selling, blocks. Nimesh is our, blocking. He tells us ahead of everyone else in the market, right? And it is more often than not that Indian mutual funds have participated. Some can argue they're giving exit to a lot of these insiders or foreign investors. But what are your thoughts on the quality of paper that's come in, the fact that a $3.3 billion IPO gets subscribed? And will you all perhaps still show that kind of appetite for the paper that's lined up ahead? What will the next Samvat be like for just the supply of paper and your appetite for it?
So SEBI has done a great job in ensuring that there is enough disclosure. And it's not that all issues have gone through. One very colorful issue didn't go through, last year. So it's not that every issue and every Tom, Dick and Harry is getting sold. People are using their judgment. And undoubtedly, thanks to SEBI, quality as well as disclosure both has improved significantly. It's not like 1991 where you will see not companies, sectors disappearing, aquaculture, bulk drugs, granite companies, NBFC, telecom companies, media companies, technology companies. Entire sector disappeared. That's not the case today.
Okay. Naren, you want to add to that?
I think no, we have to be much more careful in investing now. I think the seller knows a lot, and sometimes the seller is offering because they are able to see that it is fully valued. And so I think the easy phase where you're going to make money by investing in IPOs or QIP is over. So actually we think that we have to do much more work, and it's nothing to do with the regulator. The regulators tightened processes. So I think we have to do the right work. I think in between what happened, people could make money in anything too easily.
Yeah.
So then people just bid up the prices. Now actually we should see some failures. That will help the system actually. Then people...
Some deferments.
Then after that, people will come back to fair value. And then it will help us.
Okay, I think Pashupati has a question.
Yes, we have Pashupati as well. Sir, you've seen so many Diwalis. Your take on what to watch out for?
I think I'm the oldest person in the room. But I just want to circle back to one topic that Naren, you mentioned, the election in the US. How do you think the market will perform with Trump in the White House versus Kamala Harris in the White House going forward? And then maybe Nilesh wants to offer his thoughts.
I think not enough work has been done on it. But the belief is that Trump in the White House means that yields go up and US equities does well, and everywhere else in the world equities does badly. This is the belief at this point of time. And Trump is known as a negotiator. So this is the initial belief. Then how he negotiates things, like people believe that China has not announced the full stimulus primarily because they are waiting for the results of the US election. So I believe that there is going to be much more volatility, and what people haven't understood is in the last 4 to 8 years, slowly the US macro indicators are much weaker, like fiscal, current account, and therefore I think they have not even managed to bring down inflation to the level that it should have come down to. So I think we are headed for a volatile period because of US policy.
Nilesh, you want to offer any thoughts?
Prashant,
No expertise on US. I can barely understand Indian politics. Where will I have time to study US politics?
Any thoughts on, you got elections here as well?
State elections.
An important state election, Nilesh.
So from a market point of view, it is the federal election which matters. And many a times we have seen that to win election, people say one thing, and when they form government, they do other thing. So the real challenge for me is that today there are few things which we are doing in coalition government. For example, infrastructure spending, digitization, skilling, housing, fiscal prudence we have maintained. This is all good. This will support growth. But we are still not taking tough decisions on land reform, labor reform, farm reform, judicial reform, GST rationalization. We went backwards on pension. Now, all these things over a period of time will have impact on our growth. I have to hope and pray that the things which I am doing on infrastructure, digitization is so good that it carries my momentum forward. But I'll be at some point of time worried that the reforms which we are not doing on land, labor,
that will start to weigh.
Those will have implications on our growth.
I think, please go ahead.
Yeah, I have a question on the category-wise flows. So what we've seen is in the last 12 months at least, most of the flows are going towards mid and small. Like I would say, like the large cap category has seen like 3 to 4% of the category flows. So it is kind of got a little bit out of fashion, like large caps in the last, especially 4 or 5 years. So what do you think would be the message to investors to look at the large cap space? Because as we know, like these are cyclicals, like the caps move in cycles over the last like many years. We've seen that. So, what would be your advice on this space? Thanks.
My view is that while that is true of mutual fund flows, I think EPFO flows, NPS flows, they're all coming in large cap. So I think that balance is there. I would worry a lot if EPFO and NPS kind of flows start going into mid caps and small caps. So actually there's a good balance that actually NPS and EPFO flows are actually 100% large cap and they're not small caps. So I believe that as long as they don't suddenly say, okay, if I had invested in small cap, I would get very higher returns, then they'll be choosing the wrong time to do it. So that's why I would say that the balance is there. Then so many schemes, so many AMCs have closed down lump sum, and some of them accept only SIPs. So I think things are in between. The regulator did a lot of work on this issue. So I think things have been reasonably balanced now. And I think 6 months back, we used to be more worried about it. I think now the issue is it's been a much more balanced market in the last 6 months.
Okay, I think that's a nice way to wrap up this very special program as well. The Samvat Baithak, as we were calling it. Nilesh bhai and Naren, thank you so much for joining us. Happy Diwali.
Happy Diwali.
To both of you, your families, and of course everyone. And thank you all for being here with us on this special program. Well, thank you for watching. Thank you for staying with us. Happy sort of Diwali, happy festive wishes to all of you, your families, and more programming on the other side of this break.